The 0.1% don't pick stocks. They don't watch markets, and they certainly don't diversify to reduce risk. They design cognitive architectures so precise, so structurally sealed, that capital flows only after loss has been engineered out of existence. What you call investing, they call noise. This isn't about tactics. It's not even about money, it's about a hidden layer of thinking, so rare, so quietly enforced, that those who use it never need to explain it. And if you've ever felt that something fundamental is missing in every piece of financial advice you've heard, you're not wrong. You've just been listening to the wrong tier.
They do not avoid risk, they delete it. Imagine a vault with two doors. One opens to profit, the other to ruin. Everyone else tries to lock the ruin door tighter. The 0.1%, they weld it shut, then build the vault around that certainty. This is the asymmetry filter, a mental protocol that permits action only when the downside is not just small, just structurally impossible. Take Warren Buffett's 1988 Coca-Cola investment. He did not bet on soda. He saw a global brand with pricing power, zero debt, and cash flow so predictable it functioned like a utility. If the stock dropped 50%, irrelevant. The business still printed money. His real bet was not on price. T was on irreversible advantage. Loss was not managed. It was excluded by design. Neuroscience confirms this instinct. Elite decision-makers show heightened activity in the dorsolateral prefrontal cortex, brain's constraint engine. They do not ask, what could go right? They ask, what would have to break for this to fail? And if the answer involves more than one improbable event, they walk away. Most investors diversify to survive uncertainty. The 0.1% engineer positions where uncertainty cannot touch them. But here is what even sophisticated investors miss. Asymmetry without time control is fragile. Because no matter how bulletproof your position seems today, if you are forced to exit before the structure proves itself, and lose, and that is where temporal leverage begins. You do not just want safety, you want the silence that comes from knowing, deep in your nervous system, that nothing can take this from you. Not volatility, not panic, not even time. That is not confidence, that is architecture. Patience is not waiting, it is positioning. While the market screams, act now, the 0.1% do something quieter, far more lethal. They hold their breath until the fog clears, and only then strike. Picture a sniper in a sandstorm. Everyone else fires blind, hoping luck favors them. The elite, they lower their rifle. They wait for the wind to die, not because they are calm, but because they know. Timing is not chosen, it is extracted. This is temporal leverage, the strategic use of delay as a force multiplier, not passive holding, active latency. Consider Jeff Bezos in 2000. Amazon was burning cash. Wall Street demanded profitability. He refused. Not out of stubbornness, but because he saw a window opening only if he survived long enough for broadband adoption, credit card trust, and logistics infrastructure to catch up. He was not betting on e-commerce. He was betting on time itself, using capital as oxygen to outlast the storm. Behavioral science reveals why this works. Humans suffer from temporal myopia, who overvalue immediate outcomes by up to 300%, even when long-term payoffs are mathematically superior. Frederick, Lowenstein and O'Donoghue, 2002. The 0.1% invert this bias. They treat urgency as a trap, a signal that the crowd has lost control. They do not ask, what is the best move today? They ask, what irreversible advantage will exist in 18 months that does not exist now? And then, they disappear. But here is the silent truth. Even perfect timing collapses if your portfolio is visible, because visibility invites noise. Noise invites doubt. And doubt, no matter how small, roads the very patience you have engineered. Which is why the real game happens off-screen. You do not just want to wait longer. You want to wait unseen, so deeply embedded in your position, at no headline, no dip, no panic can reach you. That is not discipline. That is invisibility. The real portfolio does not appear on any dashboard. It does not tick. It does not flash red or green, and if you are checking your net worth daily, you have already lost. Imagine a glacier. On the surface, ice, stillness, silence, but beneath, a slow, crushing force carving valleys over centuries. That is how the 0.1% compound, not through trades, but through invisible assets that grow while the world watches screens. This is the silent portfolio, proprietary data flows, covenant-based access, regulatory foresight, and relational equity, assets that cannot be priced, traded, or copied, because they are never listed. Take Galileo in 2007. While banks chased subprime yield, he was not analyzing mortgage bonds. He was tracking global debt cycles through private central bank channels, sovereign balance sheets, and decades-old relationships with policymakers. His edge was not a model. It was access to information, for it became information. Harvard Business Review confirmed it. 73% of ultra-high net worth investors derive more long-term alpha from non-public, relationship-mediated opportunities than from public markets 2023. Yet no brokerage app shows this. No CNBC segment mentions it, because visibility destroys value. The crowd invests in what moves. The elite invest in what matters, even if it never moves at all. But here is the paradox. None of this works. If your mind is not owned by you, because every silent asset requires a silent mind, one that does not leak attention to headlines, FOMO, or quarterly noise. One that treats judgment as intellectual property, never rented, never shared, never compromised, and that demands a different kind of ownership. You do not just want hidden assets. You want a mind so sealed, so internally governed, that external chaos cannot rent space inside it. That is not privacy. That is sovereignty. Your attention is not yours. Not yet. Right now. It is leased to headlines, to alerts, to the dopamine drip of market noise. The 0.1% do not just protect their capital. They reclaim their cognition, like a sovereign state, retaking its borders. Picture your mind as a fortress. Most people leave the gates open. News scrolls in. Analysts shout from the ramparts. Twitter mobs camp in the courtyard. Every opinion, every panic, every hot take gets a seat at the table. The elite, they burn the guest list. They treat judgment, not money, as their most non-renewable asset. Consider Charlie Munger's famous line, "I have gotten so, I do not even talk to most people about investments." Not arrogance, strategy. He knew that exposure to low-signal environments degrades decision quality faster than bad data. His silence was not withdrawal. Fatigue was cognitive quarantine. Neuroscience backs this. First studies show that just reading financial news activates the amygdala. Brainosphere Center even when the content is neutral. Nature Human Behavior, 2021. The market does not need to crash to hurt you. It just needs your attention. Cognitive ownership means your emotional state is not tied to price action. Your strategy is not revised because of a viral tweet. Your confidence is not rented from consensus. You decide what enters your mental operating system gets deleted on site. But here is the hidden calibration most never learn. Even perfect mental boundaries fail if your decisions are not gated by irreversible thresholds. Because without them, you are still reacting, just more quietly. You do not just want control over your mind. You want a command structure so precise, so unshakable, that uncertainty cannot whisper through the cracks. That is not discipline. That is protocol. They do not decide. They wait for the world to cross a line, then act without hesitation. While you weigh pros and cons, the 0.1% by ever ready written their rules in stone. I move only when X is true, not maybe, not probably, only when reality itself flips a switch. Imagine ATM holding back a reservoir. Most investors poke at the walls, patch leaks, pray for rain. The elite, they build a spillway with one trigger. When water reaches this exact height, the gates open automatically. No emotion, no debate, no second guessing. This is threshold thinking, replacing judgment calls with predefined structural triggers. It turns uncertainty into binary readiness. Take Peter Thiel's 2004 investment in Facebook. He did not believe in social media. He had a threshold. Show me a network where users spend over 20 minutes daily, organically, without paid acquisition. I will write the check. Zuckerberg hit it. Thiel moved. No pitch deck saved him. The data crossed the line. Behavioral research shows that humans make 35% more accurate long-term decisions when they use if, then rules instead of real-time analysis. Goldwitzer and Oettingen, NYU, 2019. Wow. Because thresholds bypass the brainless, noise-prone evaluation system. They outsource discipline to design. You stop asking, should I? You start watching for, has it? But even this fails if you are still playing in markets that reward speed over permanence. Because the ultimate illusion is not volatility, it is liquidity, and that is the final layer. You do not just want clear triggers, you want positions so deeply anchored in reality that no market quote can shake them. That is not investing, that is entrenchment. Liquidity is not freedom, it is a leash. You have been sold a lie. That the ability to sell instantly is power. But real power, it is the quiet confidence of knowing you will never need to sell, because your position does not live in the market at all. Picture two ships in a storm. One has engines, rudders, and constant GPS updates, constantly adjusting, always reacting. The other, anchored deep in bedrock, invisible beneath the waves. When the storm passes, only one remains unmoved. That anchor is liquidity, not as a flaw, but as a feature. The 0.1% do not chase liquid assets. They build positions so rooted in real-world utility, cash flow, or structural control that market prices become irrelevant noise. Look at Michael Bloomberg. He did not sell Bloomberg LP even when offers hit $20 billion. Why? Because the terminal network was not just an asset, it was a closed-loop ecosystem feeding his media, data, and political influence. Selling it would not just mean cashing out, it would mean surrendering a node in his personal operating system, and the data confirms it. Private equity portfolios with 7+ year lockups outperform public equities by 4.2% annually over 20 years. Cambridge Associates, 2025. Not because they are smarter, but because they are immune. No quarterly panic, no forced exits, no emotional leakage. Liquidity creates the illusion of control while exposing you to the one enemy you cannot outthink: your own nervous system under stress. But this reveals the deepest secret they guard. They do not talk about exit strategies because they never entered a game they could lose. You do not want more options. You want fewer and better, so deeply embedded in reality that no screen, no headline, no market crash can pull you out. That is not wealth. That is permanence. Real wealth is not accumulated. It is revealed through what you refuse to touch. The 0.1% do not chase returns. They design positions so structurally sound, so quietly anchored in reality, that volatility does not just pass them by, becomes irrelevant. This is not discipline, it is architecture. And the moment you understand this, you stop looking for better investments. You start building a mind that makes bad ones unthinkable. You came here thinking you needed better tactics, better stocks, better timing, better tools. But the real pain was not poor returns. Here was the noise, the constant second-guessing, the emotional whiplash of markets that never sleep, the exhausting illusion that success is loud, fast, and visible. Now you know. True investing is not performed, shares protected. It lives in asymmetry, in patience, in silence. In cognitive borders so firm, no headline can cross them. This is not about getting rich. It is about becoming the kind of person wealth trusts. And if you have felt it, that quiet click of alignment, then you are already part of a smaller conversation. One that does not happen in comment sections or trading forums, but in the stillness between decisions. Because next, we confront the final myth, that wealth is built through visibility, virality, or volume. It is not. It is built quietly, through what is hidden, held, and never explained. We will go deeper in the next chapter, why wealth is built quietly, not loudly. Until then, stay anchored.